Today, we're diving into an analysis report on CRWV, ticker CRW.
Right, it argues that the stock's huge 22.6% jump means the bottom is finally in.
Exactly. All driven by a massive $55.6 billion contract backlog and a huge analyst upgrade.
The energy in this piece is just fantastic.
Oh, it's palpable. It's built on these really critical data points, and it sets the stage perfectly for that big thesis. CRW explodes 22%.
Why the bottom is finally in? I mean, you can feel the conviction.
You can, and that's what we want to build on. To really maximize its impact, we need to look at where that conviction might get challenged by a skeptical investor.
I completely agree. Conviction is its biggest strength, but, conviction needs armor. Especially with a company like this, you have to proactively neutralize the biggest fear in the room.
Which is almost always debt.
Which is almost always the debt.
Okay, so let's start right there. To elevate this from persuasive commentary to truly robust analysis, the section addressing the counterarguments has to be expanded and woven directly into the bullish thesis.
Precisely. The analysis report correctly flags the primary bear argument, this scary debt, but the weakness is that it dismisses it almost instantly.
It just pivots, right?
It pivots immediately to the $55.6 billion backlog and calls it the safety net. It's basically using that giant number as a narrative shield.
And that backlog is a powerful counterpoint, I get it. But if you never actually define the thing you're shielding against?
Then you leave the reader with an undefined risk. Exactly. The debt is mentioned, but it's never quantified. We don't see the structure, the interest rates, nothing. So the dismissal feels, maybe a little too assertive.
A bit hand-wavy.
A bit. And the tone, that celebratory Wall Street just admitted they were wrong kind of thing. It might alienate a reader who's looking for a balanced view, not just confirmation bias.
Okay, but let me push back a little. I mean, doesn't the sheer size of that backlog, $55 billion, doesn't that just speak for itself? For someone who's busy, isn't showing the huge net positive enough?
That is a fair question, but here's the thing. Tackling the ugly numbers is what separates commentary from real analysis. If you ignore the specific debt structure, a sophisticated investor might assume you either haven't done the work, or worse, you're deliberately hiding something.
So the suggestion isn't to downplay it.
No, the suggestion is to use the debt to actually strengthen the bullish case. Instead of minimizing it, you should acknowledge the specific magnitude of the financial risk, the actual debt structure the bears are worried about, and then show analytically why the 73% gross margins and that locked-in backlog inherently de-risk that specific amount of debt.
That's a great pivot. You turn a defensive point into a proactive analytical strength. So how does that look in practice? What are some concrete examples?
Okay, so you could add a bit of math right into the defense.
Okay.
When the analysis gets to that golden safety net section, right after defining the backlog, you can insert a quick calculation.
A calculation showing what, specifically?
It would show the timeline required to service the known debt. You'd use their current revenue, $1.36 billion, which is up 134% year over year, and you apply those incredible 73% margin figures.
I see. So you're modeling the cash flow?
You're modeling the resilience. It basically tells the reader, look, even if growth slows, this is how quickly their current business model neutralizes the debt.
That's powerful. It shifts the focus from the size of the debt to the speed of repayment.
Exactly. The margins do the heavy lifting. And one more thing. When you bring up that big Citigroup upgrade to 135,
yeah,
you could suggest noting whether Citi's own analysis specifically addressed the debt.
Using a third party to validate the argument. You kind of piggyback on their due diligence.
You let them do the work for you. Use their conclusion to legitimize the argument that this explosive growth just fundamentally outweighs the liability. It shows the debt concern is already baked into that higher price target. It's a much stronger flow.
Okay. That covers the financials and the external validation. But CRWV isn't just about the numbers. It's also a strategic asset. And that brings us to the second point.
Right, we've handled the market skepticism. Now we need to maximize the value of the other catalysts, especially that Department of Energy partnership. The strategic importance of the Department of Energy's Genesis Mission partnership needs to be quantifiably linked to the financial forecast to maximize its significance.
Right. I mean, the analysis correctly identifies this as a huge catalyst. It legitimizes CRWV as critical U.S. infrastructure, not just another AI company.
It's a national security narrative.
Exactly. But the weakness I see is that it's just sitting there. It functions as this great narrative point in the Y section, but it's totally isolated from the fundamentals section.
Precisely. The reader is left to just assume what the financial impact is, instead of seeing it spelled out, and that really diminishes the value of a major government deal. It feels like a footnote, not a core driver.
But what if the precise contract numbers aren't public? That happens a lot with these kinds of government projects. How do you quantify it without just speculating?
That's a fair challenge. You can't just make up numbers, but what you can do is analyze its impact on the company's risk profile, and risk is absolutely quantifiable.
Okay, so what's the suggestion?
The suggestion is to integrate that strategic catalyst directly into the financial analysis, even without exact numbers. The piece should argue how this partnership could make that $55.6 billion backlog grow even faster, or maybe how their credit terms could improve because of this government stamp of approval.
Or how it helps sustain those 73% margins long term.
Exactly. We're not just saying it's a PR win, we're saying it fundamentally changes how the market should value their debt and their entire revenue stream.
That's a huge shift in their operating leverage.
It is. I mean, think about what government validation does for a company carrying a lot of debt. It just changes the whole perception of stability.
So, a concrete example.
For a concrete example, you could suggest a section that analyzes how securing a contract like Genesis Mission immediately reduces the perceived risk of client churn inside that massive backlog.
Because if they're essential U.S. infrastructure, the revenue is seen as way more durable than if it's just from, say, commercial clients.
Right. You could argue it establishes a new, higher minimum revenue floor that isn't tied to the whims of partners like Microsoft or OpenAI. It cuts down on that concentration risk.
And tying it back to the valuation itself, when you're talking about that 135 price target, you can use the mission to justify how aggressive that is.
Yes. Argue that the partnership implies a higher stability multiplier like a premium PE ratio than a purely commercial business would get. The government is essentially validating their entire business model. It elevates them from a tech stock to something more like a vital utility.
That's a great point, and it moves us very logically from the fundamentals right into the technicals. Because the whole argument here is kicked off by that massive 22.6% price move. The chart analysis has to reflect that. Which leads to our third point. The technical analysis segment requires deeper integration of the fundamental news to establish that the recent price movement is structurally meaningful rather than just a momentum play.
Yeah, the technical section is solid. It's well laid out. It uses all the standard indicators you'd expect. The $67 to $70 double bottom.
The test of that $83 to $85 resistance.
And the RSI shift from oversold to aggressive buy. All good stuff.
But the weakness, then, is that these points, they're accurate, but they could apply to almost any stock that's bouncing hard off a low.
That's it, exactly. They don't fully leverage the unique power of this specific situation, that 22.6% explosion, combined with that very specific $135 city price target. The technicals feel a little too generic, given how specific the catalyst was.
So how do we fix that? How do we make the chart analysis serve the main narrative that the bottom is finally in?
My suggestion here is to use those key fundamental data points, especially that city target, to define the structural objective of the chart. We need to analyze that $83 to $85 resistance not just as some ceiling,
but as something more.
But as the critical psychological level that has to be breached for the market to even begin pricing in that high conviction target.
That's a really interesting way to frame resistance. It ties the $85 level directly to the fundamental shift, not just to historical trading volume. It turns TA into market psychology.
Exactly. You infuse the chart with the new reality. So for a concrete example, when the forecast says, if we break $85 tomorrow, there is no air until 100, you frame $85 as the point where the market officially shifts its focus.
Shifting its focus from what to what?
From digesting the old news, the fear of debt, the prior low, to officially recognizing the validity of that $135 target. It becomes the pivot point for the entire new bull cycle. It legitimizes the whole CRWV explodes thesis.
And we can apply that same psychological framing to the floor, to that double bottom.
We absolutely should. Instead of just defining the $67 to $70 floor, you characterize it as the level where, quote, the weak hands got shaken out, which is a line from the conclusion.
Right. You tie it directly to the bear trap narrative.
You connect the technical indicator directly to the narrative goal of the entire analysis. That way, the chart is fully integrated into the argument. It shows the price isn't just reacting to momentum, it's confirming a fundamental structural change in valuation.
This has been a really high impact